Trade tensions are roaring back this year. Tariff uncertainty is continuing in 2026, tasking investors with navigating market volatility and uncertainty. But while protectionism and transactional diplomacy are raising the risks and costs for businesses, these are also presenting opportunities for investors in certain growth markets. In April 2025, President Trump ignited a worldwide trade war by announcing tariffs on every U.S. trading partner. The new tariff regime included a baseline 10% rate added to all goods imported into the U.S., with more than 80 countries subject to higher reciprocal tariff rates, initially reaching as high as 50%. The announcements threw business and markets into a new era of caution.
It is a new era for the United States, or at least one we haven't seen in some time. If you look back at the periods between the world wars, the United States was very much a mercantilist nation. Mercantilism is very protectionist of an economy, and frankly, the U.S. is engaging in a broader view of mercantilism than we've seen, certainly I've seen in my lifetime.
That's Rick Peterson, Chief Strategy Officer at Bow River Capital. He says the tariffs are aimed at a number of goals, like raising revenue, reducing the trade deficit, and shielding domestic producers.
But there is a fourth element of it under this administration, which is interesting. It's also a negotiating tool to effectively remind the world of the United States' sovereign power and collect nations to an American style of view that is probably to the detriment of China. The tariff regime that I see here is not the end of globalization. It really is a rerouting around two major global centers, U.S. and China.
The global reaction to rising tariffs and trade wars was swift. Various countries retaliated with their own tariffs, while others entered into negotiations, reducing tariff rates for their own goods down to lower levels. Other producers, like luxury brands, simply raised prices. As an example, both Swatch Group's Omega brand and Rolex raised prices by 7 or 8%. But while tariffs are still considered damaging, experts say the effect of tariffs on the economy has not been as grim as predicted.
There is almost disappointment among certain economists that tariffs have had not more impact. We have been looking in the wrong place for tariff impact. We look at consumer goods, we look at services, and it really is coming from much more selected industries, much smaller parts of the economy that the consumers don't see.
While the cost borne by consumers rose in 2025 overall, some of the price increases were due to other factors like supply changes, infrastructure, and immigration restrictions, rather than on tariffs.
A number of the things that we buy are not really tariff related. Yes, again, Chinese toys or maybe some machinery parts from Europe, Italian furniture, these are directly hit. But when people complain about the price of eggs or the price of beef, these are not tariff issues. These have to do with the supply of the food in the United States.
2026 is shaping up to be a big year for negotiations and agreements in the tariff and trade wars. President Trump is set to meet Chinese President Xi Jinping for high-stakes talks about the future of trade and ongoing flashpoints like Taiwanese independence and defense. The talks will likely bring down some of those tariffs and result in some concessions, both from China and from the U.S.
I think China has, in my opinion, largely won the trade arguments of the last year, and so I think we're going to see some conciliation from these two major powers. I don't think that America is going to push the trade tariffs harder next year than it has this year.
That transactional shift to trade worldwide is in some cases backed up by military power. The U.S. invaded Venezuela in early January, extraditing leader Nicolas Maduro to New York City and inviting investment from oil companies like Chevron. But tariffs are more of a blunt instrument to solve complex problems like trade deficits. A tariff is fundamentally an additional tax the government imposes on goods when they enter a country, artificially raising its price and making it less attractive to the consumer. These added costs are borne by the domestic importer and not the foreign producer. While the producer of a foreign good or service will generally see their demand decrease, those costs are typically passed on to the consumer in the form of raised prices. Meanwhile, some items simply can't be made in the US without destroying the value proposition consumers want. For instance, being foreign-made is part of the appeal for things like Swiss watches and French champagne. But despite the uncertainty, the US economy might still find ways to move forward.
American business is resilient and finds ways to move ahead. We at Bow River expect a relatively good year next year, economic growth-wise. We think strong business investment is going to trump maybe slower retail consumption. We're techno-optimists. We think that the AI build-out will continue to not only create wealth for the country, but also create productivity gains. This is the new normal. Tariffs are with us. I don't think that they're going to get worse. I do think that they're going to come back a bit.
For Investors Business Daily, this is Mike Chuang.